In finance, not all investors think alike. Some play it safe, some take balanced bets, and some chase high risks for high rewards. First, we have risk-averse investors. They prefer certainty and safety, always choosing the sure thing over uncertainty. Next, risk-neutral investors. They balance risk and return, making decisions based purely on expected value. Finally, risk-seeking investors. They chase high rewards, willing to take big risks for the chance of big payoffs. This is explained by risk preference theory in behavioral economics. It shows how our psychology shapes our financial decisions. Let me show you how this works with utility curves. Each investor type has a different relationship between wealth and satisfaction. Risk-averse investors have a concave utility curve. They prefer a guaranteed outcome over a gamble, even when the gamble has the same expected value. Risk-neutral investors have a straight utility curve. They treat the guaranteed outcome and the gamble as equally attractive when expected values match. Risk-seeking investors have a convex utility curve. They actually prefer the gamble over the guaranteed outcome, even when the guaranteed amount looks better. But how does this play out in real investment decisions? Let me introduce you to Ankit, a young professional who just received a 10 lakh rupee bonus and needs to decide how to invest it. Option 1. A safe fixed deposit offering 7% guaranteed returns. Option 2. A diversified mutual fund with potential 12% returns, but some market risk. Option 3. Investing in a promising startup with 25% potential returns, but high risk of loss. If Ankit is risk-averse, he would likely choose the fixed deposit, prioritizing the certainty of his returns over higher potential gains. If Ankit is risk-neutral, he would evaluate the expected returns and likely choose the mutual fund, balancing risk and reward mathematically. If Ankit is risk-seeking, he might go for the startup investment, attracted by the possibility of high returns despite the significant risk. But what psychological factors drive these different choices? Each risk preference is influenced by specific behavioral and psychological factors that shape how we perceive and evaluate financial decisions. Risk-averse decisions are heavily influenced by loss aversion. They feel the pain of losses much more intensely than the pleasure of equivalent gains. Risk-neutral investors are driven by rational expected utility theory. They make decisions based purely on mathematical calculations and expected values. Risk-seeking behavior stems from optimism, overconfidence, and availability heuristic. They focus on potential big wins and recent success stories, often overestimating their chances. Cognitive biases like framing effect, availability, heuristic, and mental accounting all influence our investment choices. Risk preference theory, where psychology meets finance. Each approach has its place in the diverse world of investing. Your investment choices are shaped not just by numbers, but also by psychology. That's the power of behavioral economics.